It's Sunday, December 6th, 2015, and this is the Product Mentor Talk. Today we're joined by one of our mentors, Vikas Batra, Product Management Leader at Alcatel-Lucent, to lead a talk on finance and business case essentials for product managers. For those of you perhaps joining us for the first time today, people you see along the bottom of your screen here are mentors and mentees within our current session, Session 4 of the Product Mentor Program. Product Mentor Program pairs up mentors and mentees for a period of 6 months in a one-on-one relationship to help make better product people and better product decisions. So what we're going to do very quickly is just go around the room. When I call your name, just say what your name is, mentor or mentee, and a little bit about yourself. And then I'll tell you guys a little bit more about how this will be working today. Vikas, let's start with you.
Sure. Thanks, Jeremy. My name is Vikas Batra. I'm a product management leader at Alcatel-Lucent, responsible for making some cellular infrastructure products that are sold to mobile network operators like Verizon, AT&T, and so on to provide wireless service. And I'm a mentor at the program.
Excellent. Sarah?
Hi, I am Sarah Varkey. I'm the lead product manager at Sonic Bids, and I was a mentee in this session. I am a mentor.
Matteo?
Hi everybody. I'm Matteo in San Francisco. I'm product manager with Collective Health, and I'm a mentee in the program.
And Lonnie?
Hi, my name's Lonnie Rosenbaum. I'm a product manager at a company called Booker based out of New York. I'm a mentee in this program and here to learn.
And to Jordan.
Hi, I'm Jordan. I am a mentee in this program. I'm actually Vikas's mentee. And I am launching a business called Wired Concierge that helps small and medium businesses in multi-tenant office buildings get internet service. And that includes managing the product.
Excellent. And I am Jeremy Horn, aka the product guy, and I'll be moderating this evening. And so as you have questions, and for the people in the room and around the world, post your questions to our QA section on the productmentor.com/live. As the questions come in, I'll jump in and pass them on to our mentor this evening and get those questions answered in fairly real time. With all that said, we know we've got a lot to cover, so let me hand this over to Vikas.
Thanks, Jeremy. So did you ever wanted to be really financially intelligent but were held back due to any reason? Time, inertia, or you felt finance was a little scary? Well, today's talk might just make you more financially intelligent depending on where you are. And if you are one among those who find finance scary, then today's talk might just give you the confidence to overcome that fear just as many people before you have overcome it. So what makes finance scary? Some people think it's mathematics. Well, let me tell you, the mathematics is limited mostly to addition, subtraction, and division. There is no trigonometry or calculus or any of those high school subjects that when you are finished with high school, you wanted to never ever review them in your life again. So let me tell you, none of that is coming back again. What also makes finance seem scary is the jargon. And yes, there is a lot of jargon and a lot of terms. But behind the jargon, finance is simple, based on common sense concepts. And some of those concepts we'll talk about in the talk today, and hopefully you'll be able to see that for yourself. Don't also let yourself to be scared by the sheer amount of jargon or the amount of terms. Because no one knows all the terms. And you as a product manager for sure do not have to know all the terms. And if and when somebody comes up with a term that you haven't heard, just ask them. Ask them to define it. Or go ahead, check it out online, go back to the concept, understand the concept, and trust me, you'll be fine. So let's get into the talk. And before I get in, why do you need to be financially intelligent? In one sentence, it makes you a better product manager. How? Because every organization, a for-profit organization, is in the business of making money. And if you understand finance better, you can help your organization either make more money or spend money wisely, or both. Finance essentially enables you to measure and track business performance. And once you measure it and track it, then you can know when to improve it. It will not tell you how to improve it, but it will definitely tell you when you need to improve it. It also can help you assess the financial health of your suppliers and customers and partners whom you're depending on. And if the financial health is not at your level, it can also enable you to take action to address that. In addition, in many companies, there are financial metrics that are tied to getting bonus or salary hikes. So knowing what those metrics are and knowing what action you can take to achieve those targets can increase the likelihood of getting bonus or salary hikes. Also, in many organizations, the authority to make decisions that have significant impact on the financials comes when you reach a certain level. And if you are one of those who are aspiring to reach at that level, then demonstrating financial intelligence in your current role can improve your readiness to move into that role. So I hope you find the reasons compelling enough. So in terms of the talk itself, we'll talk about the 3 key financial statements and touch upon the concepts as we go along. I'll then get into a business case. We'll do an example of a business case to go through the financial statements. We'll create financial statements and articulate the same concepts again. Touch upon what you can do to improve the business intelligence of your team if you're in a team leadership role, and then finally summarize it. So let's get into the financial statement. The first statement is called the income statement. And in simple terms, it just tells what is the money coming in, subtract the money going out, and whatever is left is either profit or loss. It shows that over a period of time. It could be a month, a quarter, a year, whatever. But in simple terms, money coming out, subtract money going out, whether it's profit or loss. The statement is also called a P&L statement, a profit and loss statement, or an earnings statement, or a statement of operations. So one statement and 4 terms. You can see the jargon is quite heavy. The next statement is the balance sheet. It shows the financial health of an organization at a specific point in time. Unlike the income statement, which goes over a period of time, this is showing the health at a given point, reflecting all the work that has happened over the multiple periods during which the income statement was made. And how does it do that? It basically shows the assets. Assets are things that an organization can use to make money. It shows that it balances that out with liabilities. And liabilities are essentially the promises and commitments that you have made to give someone money. So for example, if you take a loan, you have made a promise to pay the loan back, and that's a liability. And then hopefully the assets is more than the liability. And the difference between the asset and liability is what's called as the equity, which is essentially what the owners own in the business. So we'll get a little bit more detail into each one of them. The third one is called the cash flow statement. And it's just like your bank statement. It shows the cash at the start of a period, cash flowing in, how much is cash flowing out, and what amount of cash is left at the end of the period. You must be wondering, isn't this same as the income statement? And if you are, you're absolutely right. But what is the difference between income statement and cash flow statement? Why do we need 2 different statements? We'll touch upon it as part of this talk itself. So let's start with the income statement. That's the statement as product managers you'll be most involved with. So I'll talk a little bit more detail about the income statement and touch briefly the balance sheet and the cash flow, because income statement is the one which we need to be focused on. So first step is every time you look at somebody's income statement, it will show you the name of the company. It's an income statement, and it will tell you for what interval. You can see here it shows for 5 months ending May 2014. And it tells you what is the revenue you made. Revenue meaning the money you have earned by selling something which is part of your core business, and gains, which is money coming in but not part of your core business. For example, you may have some money sitting in a bank giving you interest. That interest is a gain, money coming in but not part of your core business operations. Similarly, on the expense side, expenses are the money that you have incurred in order to realize that revenue, and losses are again money that's going out but not tied to your core operations. So you take the two, subtract it out, and you get your net income, profit or loss. Simple as that. Now you expand it further and get into more details. So break it up. Break the revenue into sales revenue, which is money coming from the core operations. Interest revenue, if you have some money in the bank, money comes out. You may have sold some assets and you may have had some gain there. So that's gain on sale of assets. Similarly, break up the on the expense and the losses side, cost of goods sold, which is basically the cost that you're incurring to sell and get that revenue. You may be paying commissions to the sales team to make that sale. Office supplies, office equipment, advertising expense that you might be making. Interest expense, like I talked about earlier on, it could be that some money sitting in the bank that's earning interest, not part of the core operations. You could also have one-time events that, let's say there was a lawsuit and there was a loss, and there's money going out because of that. So you subtract those as well. And again, you subtract it all out, and that gives you your net income. So as you would have figured out by now, it wouldn't be nice if we were to just rearrange these revenues and cost numbers such that we just look at the core business operations as different from the rest of the activities. Because it's all mixed up at this point. And that's exactly what happens in what's called as a multi-step statement. So what we've done here is started with the sales, and then we've put the cost of goods sold, the cost that the company has incurred in order to realize that sale right up front here. And instead of subtracting at the very end, we subtract it at this step itself, and we create another term which is called as gross profit or gross income. So it's just showing at the very core level the direct cost or the cost of related to the goods that you have sold. How much is that, and how much is the revenue right to that, and are you making money at this level or not? You then go one step further and group together all the operating expenses, still part of business operations, which selling expenses, commissions, advertisement, administrative expenses, so on. Add it all up, and now you take this total operating expense and subtract from the gross profit to give you what's called as operating income. Basically, this is telling you what is happening at the core business operations level. Are you making money? If so, how much money? And then you have these non-operating and others, which has this interest revenue or one-time events and so on and so forth. Now this thing could get further broken down into multiple steps, but from a product management perspective, focus would mostly be on the operating, because that's where product managers can make a lot of difference. So the other point I want to make here is that a lot of time you see numbers here, but a lot of people will make percentages or ratios out of it. They look at the gross profit divided over sales and give a percentage out of it, 25% in this case. They look at operating income, divide again by revenue, make another ratio, 12% in this case. And the idea there is to eliminate the absolute numbers and just look at percentage to be able to compare more effectively across companies, across products, and so on. So the whole idea here of regrouping these costs is to get a different view of the business, if you will. So the gross profit gives you a focus of how good the product design is, how good the product manufacturing is. If you're getting a good gross profit there, that means your design is good. If you're losing money at gross profit, your design has to change. The operating piece gives you a view of the business operations. How effective are the business operations? And finally, the non-operating piece, which, as I said, could be further broken into how effective is the financing piece. You're raising money, how much interest you're paying, how much interest you're getting with the money that you're not spending right away, and any of the one-time transactions that can go about. What usually does not change is that the very first line is the sales revenue, and that's usually called as top line. And the very bottom is the net income line, which is also called as bottom line. Again, more jargon. Now, this is a rearranging of cost and revenue numbers in one way, which is typically reported out externally. But you could also have different formats internally. You could have any format you like, in fact, internally. Just an example here is you're taking at the total sales, and then you're first breaking up the variable expenses that vary by the sale being made. If a sale is made, these expenses are incurred. If not, they will not be incurred. And you can break it up by products as well. So let's say you have 2 product line, you can see it's being broken down by individual products. And so you take the sale, subtract the variable expenses on it, and then you get what's called as contribution margin. Um, another metric, you could again put a percentage, but the difference essentially is how the costs are rearranged. The only difference from the previous one was the commission expense, which was not in the gross profit, is now coming up here because it's tied to the sale happening. You have fixed expenses for the production line split up over the 2 products, and then you have fixed expenses which are common across the 2. So the whole idea of rearranging is essentially, by rearranging, you can assess the effectiveness of the business, a certain dimension, a certain function of the business. It's not just assessing it. By these metrics, you can even target certain effectiveness of the business. So you could say, you know what, last year our commission expenses were $5,000. This year we want to make even more sale, but at a much lower commission expense, and therefore we want to drive our sales team much faster. So you can create those targets, and then once you create those targets, you can drive actions to meet the target. That's the whole idea. Couple of concepts that I want to talk about here is, one is on the allocations. And by allocations, what it means is that you have to understand which cost is getting into which head, meaning which item is covering what cost, and the way you do that could make an impact. So for example, if let's say product manager is a function, if you allocate that cost in cost of goods sold, then that will impact your contribution margin. But if you put that cost in fixed cost, then it will not impact your contribution margin. So if you're making your decision on a product based on contribution margin, then you need to make sure that you're aware that product management is either in or not out. So fundamentally, the way the allocations work, there will be bias. You could argue there's bias there, and that's okay. But the key thing is to be aware of what the bias is and take that into account in whatever decisions you're trying to make around it. Another concept is what's called as the accrual-based accounting, which is a crucial concept, which also tells how the cash flow is different from income statement. And the whole idea here is that revenue is reported on the income statement when it is earned and not when cash is received. Similarly, the expenses are reported when those are incurred as they're caused by that revenue. In other words, the expenses are matching with the revenue. The expenses incurred in order to earn that revenue. So earning revenue, as you have figured out, is different from getting the cash. So sometimes you will sell something to the customer, and customer says, yes, I buy it, but the actual cash will be received 30, 60, or 90 days. So the idea is to report on income statement the sale date and not the cash receiving date. And the objective here is to essentially avoid any mistimed transactions that may happen that may distort the figures. So for example, if you had a lot of money that was coming in this interval, which was actually the sale happened in the previous interval, so you'll see a lot more sales here. Or the other way around, you made a lot of sale, but the money was coming in the next period, and this period will look inferior and the next period will look nice. So the whole idea is to remove that distortion and focus on what is it that you actually did. And that's why this is different from the cash. When you look at the cash statement, you will actually look at when the cash came in. Another example here is inventory, for example. In order to realize certain amount of revenue, let's say you build a lot of inventory, stuff that you can sell, but you didn't sell it. So you incurred expenses to develop that inventory, but you have not sold it, so it's not going to show up in the income statement. Where will it be? It will be in the balance sheet. So that comes to our next point, which, as I mentioned, shows a snapshot of the financial position of the company in terms of assets, liabilities, and shareholder equity. So a simple view is here. The balance sheet is always at a given time. Every time you'll see what the time is, and you'll see assets on one side balanced with the liabilities and owner equity. Assets are broken up again into different categories: current assets, investments which are going to translate into revenue in 1 year. Investments are more long-term. Property, plant, equipment are also more long-term. Similarly, liabilities, current liabilities that you made promises to pay money within the year. Long-term is beyond that, and as I mentioned, the delta is the owner's equity. Getting into a little more detailed view on the balance sheet itself, you can see current assets are broken into cash and so on and so forth. Inventory, as I was mentioning, is shown up here. Investment, property, plant, all the equipment that you have. Liabilities, you can see short-term and long-term, and then stockholders' equity. One interesting observation is you can see that this depreciation is a negative on the asset. So why do we have a negative asset? So this concept will be covered when I talk about depreciation. So just hold that thought on there. Some of the metrics that you as product manager will be caring about is inventory. If you have hardware products, then you have to make sure that your inventory doesn't go up. You would also be concerned about this line item here, unearned revenues, which is essentially the money that you have received from the customer, but you have not earned that revenue, meaning you have not done everything as part of earning that revenue that's tied to it. So typically from CFO, product managers may get into that situation to do whatever needs to be done so that that money can be earned. So let's get into the depreciation piece. The whole concept of depreciation essentially is, let's say you bought an asset, a machinery for 300K, and you plan to use that over a period of 10 years. So instead of showing the 3,000 as a cost that incurred in this year, what you do is you reduce the amount, or you depreciate the amount to the extent that is being used in that year. So it's very similar to the accrual concept, which is saying that, hey, this machinery which was 300K was used only 1/10 in year one, 30K in this case. So therefore only 30K amount should show up in the income statement. So that's why it's depreciation, and over time, every year it will drop by 30K, 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 and so if you go back to the balance sheet, what you see here is accumulated depreciation. So whatever equipment is bought, in this case 200K, over the years it is being slowly depreciating down and down, and therefore the value of the asset is coming down, and that's the accumulated depreciation that you see in the balance sheet. Cash flow statement, as I said, cash in, cash out. Because its income statement is not tied to cash flow, this is the statement that shows the cash view. Typically how you create it, take the net income from the income statement, address for any non-cash transactions, increase in accounts receivable or increase in inventory. I gave you the example. So if inventory has increased by 200 in this case, then that is a cash transaction that has to be addressed. There will be other non-cash items, non-operating one, typically in the cash flow, but you don't have to worry about it because the focus is on operations. And then at the end of it, you see what is the cash at the end of the year. So in terms of the financial statement, the key message here is that they tell you the financial health, but they don't tell you about the non-financial health. They don't tell you, for example, how the customer satisfaction level is, or how the competitive environment is, or any of the non-financial health like employee engagement, for instance. So while they tell you a lot, they don't tell you everything about the organization. So now we get into a business case, and as I mentioned, we will go ahead and do an example here. And the whole idea of doing a business case is to weigh the benefits with the cost. Do the benefits outweigh the cost of making a decision? And that decision could be, should we make a new product, which is what mostly product managers get involved in, but it could be anything else: buying a new capital equipment, acquiring a company, adding more staff. So the whole idea is to determine any decision, do the benefits outweigh the cost? And we'll do that, as I said, by running an example and creating a P&L or an income statement and cash flow. So what are the steps? The first step, identify all new revenue opportunities as a result of this. Identify all costs that need to be incurred to realize revenue. Careful on that because a lot of time costs are hidden. So make sure you cover all costs, upfront cost, end of life cost, and so on. Map them out over a timeline, which year or which quarter, whatever you're doing, and then assess the impact to the bottom line. And we'll talk about the methods how to assess it subsequently. If you're making the business case, make sure to capture the unquantifiable benefits because those are not covered in the business case. Stuff like we should do this decision or we should make this investment because there's a strategic fit with the organization, or we are winning a new business, or we are creating new goodwill, and so on and so forth. So let's get into the assessing the impact piece, which is where the focus here is, and we'll go through each one of those. I'll give an example here. I'll explain what the concept is, and then we'll go into the example in a spreadsheet. So the first couple of ones are return on investment and break-even analysis. Return on investment is pretty straightforward. It's essentially looking at the benefit received for every dollar invested, expressed in percentage terms. So if somebody says 4%, that means for every $100 invested, we are earning 4%. As simple as that. Very easy for people to understand, very easy to compare. Let's say you put in a bank that's giving you 3% interest. If you're making 3% in investment, you could say, might as well just put it in the bank. Why do I have to do that? So pretty simple, straightforward. In terms of calculating it, you calculate the net return. In product case, it'll be total benefits minus total cost. And then that's your return, and then divided by the cost of investment. You do need to be careful with this is that in the return and the cost will vary by context. Multiple people will define return different and investment different. So for example, in our case, we're doing a business case for a product, our return will be net income. But if you're looking at return on investment on advertisement, for instance, their return may be increase in revenue and the cost may be just the additional advertising expense that they incurred. So just be careful on the term. Break-even analysis, pretty straightforward as well. It just looks at how many product units must be sold in order to recover the absolute investment. So if we are investing $100 and we are making $4 for each unit, you just divide the 4 by 100 and you need to sell at least 25 to recover the investment that was made. It essentially gives you a view as to how realistic is the price point and the demand that we're assuming. In terms of calculation, pretty simple again. Take the contribution margin per unit by subtracting the variable cost from the selling price. So that's the contribution margin per unit. And then take the total investment, divide that by the same contribution to give you the volume. The same thing is shown here pictorially. You can see in this case we have a fixed amount of investment here, and as the revenue comes up by quantities, that's the break-even point. Now, if you have a different case where your costs are also going up as the units go up, then you can see the curve at this curve here. This is the curve of the cost as they go up. This is the revenue, I'm sorry, and this curve is the cost curve. And where the revenue curve meets it and exceeds it, that's the break-even point in terms of the units. So let's get into an example and see it in a real example. Let me bring it up. So what I've done here is I've created a very simple case, and this is an income statement for this. So let's say we're creating a new product and we think we can sell 1,500 of those at $1,000 price point. So your total revenue is simple multiplication of that. And let's say the cost of goods sold tied to it is $550 each, and that's your total cost of goods sold. So the gross income in this case, or contribution margin, which is the same in a simple case, is 450. 500 minus the 1,000 minus the 550, and this is our gross income. In terms of percentage, simple division, 45%. Now we also have, let's say, fixed costs. We have an R&D cost of 300K, and we have to purchase an asset of 60K, and we also have to do selling and general administrative expenses of this amount. So to arrive at the operating income, we subtract all of these costs from the gross income. So that's our operating income percentage. And let's say we have some non-operating expense as well. I took an example of tax here. that we're paying at 35% on the income. So that's your net income after tax, and so that's your net income. It's a simple, basic income statement. In order to get the return on investment, you take the net income and divide by the investment. And the investment that we made in this case is the R&D investment and the purchase of assets. So pretty simple, 16% rate of investment for our investment with these numbers. On break even, we look at the contribution margin that we got, and the contribution margin in this case is $450 per unit, and then the investment is this, and we divide the total investment by the contribution margin per unit to get the number of units that must be sold. So we need to sell 800 units in this case before we will recover this money that we are investing. Now this is a simple case, but what if your revenue and cost profile spans multiple years? So let's say I have some numbers here that I put on. So let's say it spans multiple years, and let's say we also have to spend some money in the year before we start to make some revenue. So let's say, so let me just lower it down a bit. So let's say we have the revenue profile, we have the cost profile on the cost of goods sold, gross income same 45%, but I did a little change on the R&D cost. I said, okay, year one we will spend 500K, year two 300, and then we have a certain cost profile after that. And for the assets, let me make a little change here as well. I said, let's say the asset was at 300K, and we are depreciating it for a 5-year period at a fixed amount at 60K each. So we bought the asset in year one, and we are depreciating 60K every year on that. Similarly, I had a profile for SG&A. Now you compute the operating income, and then you put the tax, and then you get the net income. So if you have a profile like this, how do you look at the return on investment? You could say, okay, add up the net income, which is what we've done here, and then divide it by the sum of the investment that we have made. We can do that. We can certainly do that. But the problem with that approach is that it does not take into account what is the time frame at which we are getting the revenue and what is the time frame for the cost. So for example, if we had a situation where we had heavy amount of cost in the beginning and the revenue was only coming mostly in the out years, not much in the in years, and we had another situation where the costs were more or less consistent across the year and revenues was also consistent across the years. So if the total is the same, then ROI just will take that into account. It just does not distinguish that. But common sense tells you that if you are getting if you are having to do an investment where the costs are very high in the beginning and revenues are only coming late, that is inferior to another business case where the costs are more or less consistent and the revenue is also consistent. So how do we take that? How do we assess that impact to bottom line through this? So we get into what's called as the concept of present value or time value of money. So what is time value of money? Let me just go back to my screen shared. So the time value of money essentially means that a dollar that you receive 5 years from now is worth less than a dollar you receive today. And why is that? Because that dollar that you receive today, you can invest it. You can invest it in a bank and make more out of that. So that means that makes the dollar today more valuable. Similarly, there could be inflation. What you can buy from a dollar today, you might not be able to buy that on the dollar 5 years from now. So for example, let's say you buy a Kellogg cereal today for $4, 5 years from now that may be $5. So the ability of the dollar to buy a good also drops. So that's essentially the basic concept of time value of money. So how do you capture that? So you capture that by what's called as present value. And let me go back to the screen, to my spreadsheet to explain how do we capture that. It's very similar to what you get in terms of an interest from your bank. So let me start with an interest and then I'll come to the present value. So let's say you put $100 in a bank at 10% rate of interest. At the end of year one, you'll get 100 plus 10% of 100, which is $110. At the end of year two, you will get 110 plus 10% on top of that 101, which gets you 121. At the end of year three, you will get 121 and 10% on top of that. So what you're doing is essentially you're taking the $100 and multiplying by 1 plus 1 in this case 3 times for 3 years, and similarly you'll have to multiply it by t times for t years. Simple, right? You get the money, 10% interest year 1, you get another 10 on top of it year 2, you get another 10 on top of it year 3, and so on and so forth. So that's the interest rate. Now when we're doing the present value, we are going in the opposite direction. So we have these monies here, but we're trying to come to the present value. How much is it today? So which is what I have here. So if you have $110 today, the present value is $110. But in order to get 110 in today's terms, in present value, you need to have $110, because now you have to divide it by 1.1 to get to 100. Similarly, in year 2, you would need $121, because now you have to divide it with 1.1 twice to arrive at $100. And similarly for year 3, it will be $133. So if you have to come up with the present value for our business case, we look at the cash flow in year 0. We just take it as it is, assume this is the present value today itself. You look at the cash flow in year 1, get it to the present value. Year 2, bring it to its present value. Year 3, bring it to its present value, and so on and so forth. So essentially what you're doing is you're taking the value, reducing it or discounting it, and getting it to what it is in its present value, in its today's term. So that's the whole concept of present value. So now let's go back to our business case and see what our present value looks like. Now we could quickly start with net income, right? That's the income. We get the present value of each one of them. But no, we can't. Why? Because of the accrual concept. This is not cash, right? This is just income. In order to get the real present value, we have to look at the cash, because cash is what's coming out of the bank. Cash is what is losing value, has value in terms of time. So we really need to make a cash flow statement. So let's do that. Let's make a cash flow statement for this. So here I have a sample cash flow statement here. So what do? We start with the net income, as I said, and we make adjustment for the non-cash transactions that we did in the income statement. So the only non-cash transaction that we had in our income statement above was depreciation. So if you look here, we subtracted 60K here every year, even though the asset was bought in year 1 with 300K, we subtracted 60K every year. And this 60K is a non-cash transaction because the cash was spent here. So in order to adjust for it, neutralize it, we add 60,000. So it's effectively eliminating that. So that gives us our cash inflow, net income plus the adjustment. And we also have to add the 300K that we spent to buy that asset. So remember, this 300K here did not go into the income statement. Only the 60 went. But from a cash perspective, this 300K was spent. It was cash outflow. So we have to add that in our outflow. So we add them all up, and this is what we get. Is our net cash flow for every year. It is not discounted. We now need to discount it or make it what's called as the present value of cash. And it's very simple. You take the year 1, put it as is. You take the year 2, just divide it with 1 plus 10%. This is what we have. You take it year 2, you divide it with 1 plus 10% twice. You take it year 3, divide it by 1.1 thrice. year 4 divided 4 times. So you do all of this and then you add it all up, and that is what gives you your net present value. So it's just the cash flows that you have from the business discounted to their present values, and then just add it up to get you your net present value. So let's go back to the um, to the uh, to the slides again, and once again, let's go
Before you
back.
jump, Vikas, before you jump into that, Jordan's got a question. Let me hand it over to Jordan.
Go ahead, Jordan.
Go ahead.
Yeah. So one of the questions that I have is like, how do you calculate COGS on like a web, SaaS or a media product, where kind of on the face of it, it has almost no marginal cost? I mean, you could do like server cost. Obviously there's some server. Amazon. Let's say you're running everything on Amazon, you've got some cost, but that it's really small, and yet at the same time, it feels a little bit weird to say, well, we have 100% gross margins. I mean, that just seems a little bit utopian too.
Yeah, no. So the short answer is it just depends. There's no right answer. What you need to do in a software case, for example, I know some organization will put as COGS the cost of media. So let's say you're shipping the software in a CD-ROM and packaging it and shipping it out. They would treat that expense as COGS, but the actual cost of software development is a fixed cost. Now, if you're delivering that service over the web, for instance, you could argue that even that is not part of your cost of COGS. So again, it just depends how you account it. It's absolutely fine to account it and say there is no COGS for us. It's delivered over the web. There is no direct cost of goods sold, and a gross margin is 100%. It's absolutely fine. But as long as you understand that and you're making your decision based on that, you're not making your decision based on gross margin, that's fine.
Great. And for everyone else, keep the questions coming in at theproductmentor.com/live. With that said, back to you, Vikas.
All right. So we went through the net present value calculation here, and I'm just showing the same information that we just went through in the spreadsheet over the PowerPoint. And here's a formula here, pretty simple to what we did. Take the cash outflow in the year 1, that's why shown as negative, and hopefully the cash flow is positive in year 2 onwards, and you're dividing by 1 plus R here, R being the rate of discount and T being the time. And we did it over the years. We do it over quarters or half yearly, whichever way it makes sense. Now, let me just stop here and state that this net present value calculation, if you have followed this all along, this is probably one of the most complex concepts that's out there. I've heard people say, oh, NPV, let's not get into that. That's too complex. There's a method to calculate that, and we arrive at that somehow. So just wanted to say, in terms of the mathematics involved in finance, this is probably as complex as it gets. Of course, there are more concepts that are there, but probably not as complex as this one. In terms of the decision making, if your net present value is positive, or there is no other investment to be made, you have money sitting there, then it's better to invest. But if you have multiple investment, then you have to look at which one is giving you more when. But fundamentally, if NPV is close to 0 or marginally positive, because there are assumptions that are being made and you could go wrong, it's a judgment call whether to make that investment or not. So some organization like ours treats at NPV positive as a basic criteria to have any further discussion. If the NPV is negative, there's no discussion, but if it is positive, then there's discussion whether to pursue that investment or not. So I went through the example, and I have the example in the PowerPoint as well. So if somebody wants to look at the PowerPoint, all the information is located here as well. We now get into sensitivity and scenario analysis, and that's pretty simple. The whole idea of sensitivity analysis is to see how sensitive is your NPV to the input variables that you have. So for example, if you change 10% or reduce the 10% in price per unit, your NPV drops by, let's say, 20%, 19.5%. Whereas if you increase the R&D cost by 10%, your NPV only drops by 2.3%. So what this is telling you is that your NPV is much more sensitive to the price per unit compared to R&D cost. So you really have to have greater confidence in the price per unit. You have to keep monitoring that piece as you go along, because if that drops, then you're going to have a significant drop. Whereas on R&D cost, it's okay if you relax a little bit. So you can do that on multiple variables and determine what the sensitivity is on each of the different variables. The next one is scenario analysis. And what it does is you could have multiple variables that could move around, right? And you could set under certain set of values on these variables, we call them as a scenario. This is how the NPV looks like. And you could create multiple scenarios. You could create a most likely scenario where the values are most likely. You could create a best case scenario, be more aggressive. You could make a worst case scenario, be more conservative, or any of the scenarios that you want. But the whole idea is to look at across multiple input variables, how does the business case look like when all of them change together. So to summarize the business case, the key point is a business case is only as good as the assumptions that are made behind it. So whenever you are making a business case, do whatever you can to get greater confidence in the assumptions that you make. And sometimes if the level of confidence is not high, it may make sense to just do a pilot, a trial, a friendly user concept, wherein you're making small investment but getting greater confidence on the assumptions itself. So keep that in mind, that the assumptions are really crucial, and whatever you can do to gain confidence in the assumptions, that work is worthwhile. Business case, as I told you, tells you only the financial part of the story, so do not ignore the non-quantifiable items. So if you're making a case or you're evaluating, don't just limit yourself to the financial business case, although that's the subject of the talk. The decision also needs to include the non-quantifiable items that I mentioned. If you're making a case for a business case to your management, having a business case does not replace influencing effort. You have to understand who the stakeholders are, who the decision makers are, what is their decision making style, who are the influencers, how can you get them on your side. So the whole persuasion and influencing effort, just having a business case doesn't mean that you don't have to do that. You still have to do that. When you're comparing across products or business cases, key thing to watch out is to make sure that the aggressiveness is consistent. By aggressiveness, what I mean is that the assumptions on revenue, on costs, are equally aggressive, in the sense they're not being too optimistic or too pessimistic, or the level of optimism across business cases is comparable. Because a lot of times what happens is different individuals will do different business cases on different products, and if you're evaluating two different products from two different individuals, they may not be as consistent in terms of how optimistic they're assuming the market would be. And finally, tracking and adjusting to your business case as you go along is important. So let's say you make a decision to invest, or somebody makes a decision for you to invest. Once that is done, it's important to track it as you go along. Are you reaching the business metrics that you were wanting to reach? And specifically, there's a lot of metrics sensitivity analysis can help you identify those that you really need to focus on. So improving the financial intelligence of the team, that's the next topic. And I talked about the benefits, but just to reiterate it, having higher financial intelligence of the team helps the team make better decisions at a team level. It also helps that if there are goals coming from the senior manager on the top, driven by them, it helps the team members to understand the logic behind it. It does not come across as that, oh, management doesn't know what they're doing, they're just giving us these new goals every so often. So they'll understand it, and once they understand it, they're more likely to take action to meet those goals. Of course, as I said, it's going to improve the management effectiveness of the entire team. In order to do that, just doing a one-time workshop or giving them books on it probably would not work. What really needs to happen is you need to put these steps on a regular basis. And by steps, some of them is do informal training session. If somebody is doing a business case, let him walk through the business case to the entire team, what he did and how he went about doing it. Have periodic numbers or metrics meeting. How are we doing on these metrics? How are we doing on the business case that we did a year ago? How are we tracking that? Discuss those specifically in meetings, and that is what will drive people to think as to what action to take in order to improve it. You could also look at putting certain targets in the performance objective itself. So once you have these targets in the business performance objective, that means the bonus is tied to it, salary hike is possibly tied to it, and that can drive intelligence as well. And of course, getting the buy-in from leaders help, like in any other case. So here are some references in terms of for more information. Accounting Coach is a very good site if you're wanting to understand some of these concepts. But your company's finance department is also a very useful reference. And another point that I didn't make during the call was that as product managers, interact with your finance people and make them your friends, because you'll be surprised sometimes as to how much insight you can get from them. You may not know, for example, that how much money your organization may be spending on customer service. You go in, you look at the numbers and say, we're spending so much money on customer service. What can we do in the product to reduce that customer service cost? So work closely with your finance department, and you'll be surprised as to how much insight sometimes it can give you. But going back to the references, as I said, internet is a very good source. If there's a new term that comes about, just go Google it out, search it, and you'll get plenty of information out there. But if there is a term, and sometimes there could be a term that somebody has defined by himself, you just have to ask them what is the definition. So to summarize the talk, financial intelligence matters. It really makes you a good product manager. You can make a difference in your organization if you have higher financial intelligence. Don't be scared by jargon. That's, as you figured out, you may have figured out during the talk that some of these things are called by multiple names, but that may sound scary, but it really is not. Work with your finance and CFO controller. I just talked about that. In terms of the financial statements, as I said, you don't have to memorize all the terms. Just you may have specific financial statements in your organization, and you may have some specific metrics that the organization cares about. You just have to worry about them, and often there are just a handful of them. They're not a whole lot. So don't have to worry about memorizing the whole host of terms that are out there. Clearly, understanding the metrics your organization tracks or aims is important, and also to understand what impact you can make in order for your organization to meet those goals. Similarly, if you're driving team behavior, you can use the metrics. So finance department is out there creating these metrics anyway. It's an opportunity for you to take those metrics or even modify them, create your own metrics, and bring them in and use them to drive your team behavior and effectiveness of the team. So finally, hope you've seen through this talk how some of these concepts in finance are simple, based on common sense, and if you just take the jargon out, there's really nothing to be scared of. Thank you so much.
No, it was a great talk, Vikas. This is it's a very great way for a lot of product managers to also think about how to connect the KBIs with the KBOs of the company. So this is a great foundational piece here. And again, I just want to say thank you to our speaker, Vikas Batra, Product Management Leader at Alcatel-Lucent, for today's discussion of finance and business case essentials for product managers. And as always, and for those of you who have been asking, the presentation will be posted to our SlideShare channel. And a big thank you from me, Jeremy Horn, the product guy, and everyone else who joined us today in the Product Mentor. And also don't forget, if you're interested in being a product mentor like Vikas, to mentor all types of product people all around the world, please visit theproductmentor.com and sign up today to be a mentor. Session 5 starts on May 1st, and we're looking for a lot more mentors. Looking to fill a new product job with a great product person, feel free to visit our very own free-for-all all around the world it's used, job board at theproductjobs.com. And once again, thank you guys, and I'll see you all next time. Bye.